So when you enter a position, you need to think about a stop loss in order to control risk. And if that position turns profitable and prices are moving in a favorable direction, you also need to think about a stop loss to lock in profits. And today, I want to show you an indicator that can do that. Hey, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. And today I want to go over the ATR Trailing Stop and show you how to use it on StockCharts ACP. So I'm going to show you how to use the ATR Trailing Stop for long positions, for short positions, and also in a stop and reverse manner, kind of like the parabolic SAR indicator. We're going to go over the settings on StockCharts ACP and show you exactly how it works. This is the StockCharts ACP charting platform, advanced charting platform, and I've got the ATR Trailing Stop twice on this. And this is part of the Trend Investor Pro Indicator Edge plugin. And on the right-hand corner at the bottom, you see the plug there. And you can click that to find out about the plugins available on StockCharts ACP. If you want to know more about this Trend Investor Pro Indicator Edge plugin, just go to the search box up at the top. There's a little icon for the search ACP plugin, and there you will see a support article telling you all about the plugins. And on the right, you can see the outline there. And then we have the Trend Investor Pro Indicator Edge plugin there. And you can buy it, of course, and you can read more about it with some very detailed documentation that I've put together covering all the indicators. And this one is the newest addition to the plugin. It's the ATR Trailing Stop. So the origins of the ATR Trailing Stop go back to 2005. Now, first we have an article in June 2009 by Sylvain Vervoort, a fellow Belgian, and he featured the ATR Trailing Stop in that article for stocks and commodities. And of course, Stocks and Commodities is the classic magazine with all kinds of indicators and information for technical analysis and trading. And then Vervoort also has a website where he talks about this indicator, the average true range trailing stop. And you can just Google his name, Vervoort, and also the ATR Trailing Stop to find more about that. So if you're on StockCharts ACP and you have the plugin installed, you can go over to the chart settings in the upper left-hand corner and then scroll down where you'll see all of the Trend Investor Pro Indicator Edge indicators. And there's ATR Trailing Stop at the top there. And you can click that to select it and add it to the chart. And once you click it, you need to click on the chart or set the anchor date. And I'm going to go back up here to the one I've already put on. And so if we look at the settings here, you can see when you hover over the chart and click, it's going to move. So I've currently got the ATR Trailing Stop here. And if I change my click and I click here, it's going to change that stop to start there. That's the anchor date. Or I can change it to say I want to do it here in mid-November. But I usually pick the anchor date as the breakout date when you've had a signal and you've got an entry. So we can see here we had a little pullback and a breakout. And so I'm going to click there to anchor the ATR Trailing Stop there. So what exactly is this ATR Trailing Stop calculating? Well, this first point on the anchor date is based on the close. And if you scroll down on the left, or I'm going to scroll down, so we can see that's calculated from. And so it's calculated from this closing price right here. And we're using the ATR 22. And we're using a multiple of that ATR 22, that value at the time of the anchor date. So we've got 3 times ATR 22, and we subtract that from the close, and that gives us the trailing stop. And so what happens is, as the trade becomes favorable, and prices move up, the trailing stop rises. And then you can see prices move down. And what it does is when you set that anchor date and you're calculating from the close, it means that the ATR trailing stop will rise as long as you have a higher close. And so you can see here we had a higher close after the anchor date, and then we pull back and we didn't get a higher close until here on November 16th, close only. And so that's why the ATR trailing stop rose there. So here was the high close, and you calculate the ATR value at the time of the high close. And because we didn't have a higher close, we had a flat ATR trailing stop, and then we got a higher close, it rose, and then we got flat again, and then we rose again. And you can see here that this date here, December 8th, was the highest close. And so we take the highest close of the ATR trailing stop since the anchor date, and we subtract 3 ATR values, and the ATR value is based on the ATR value on the highest close. So it would be December 8th here. And so that's why it flatlines here when prices move lower. And if prices go below that, then we trigger the stop. And you can see here you have a trigger price as well. So you can say, I want to trigger on the close, I want to trigger on the low. You can also get exotic and use some high-low close divided by 2 and such. But I'm just going to stick to the close right now. I'll show another one with the low. So I'm going to reset that with the anchor date. And once you've done that, you'll go up to the left and close that. And then it will be set on the chart. So if you're trading on this breakout and you're using this strategy, you would put your stop loss on a close below 360.14. Now, whether you want to trade intraday, and exit during the day is totally up to you. I'm a pretty much end of day kind of guy. So if we close below 360.14, then that would be a signal to exit on the next day. So don't forget to check out trendinvestorpro.com if you'd like to know more about how these trailing stops work. In particular, I've got an ETF report every Thursday where I group the ETFs according to trend, setups, and patterns, and some of those do include the ATR trailing stop for follow-up. So here is a different version of the ATR trailing stop. And if you look over to the left here, you can see I've got 22 periods for ATR. The multiplier is 2, and the multiplier is probably the single most influential variable in this for this indicator. If I set this to 5, you can see immediately that I'm going to get a much wider stop loss. And if I set it to 1, I'm going to get a very tight stop loss, and it's going to trigger. So it's kind of a judgment call as far as where you want your stop loss. Usually when I get a breakout, I like to put it just below the low, before the breakout, or near the low. And so it is a judgment call, and you can change it as prices go up if you want. But the direction is long here. I'm calculating from the low. So that is the base for the calculation. The lowest, the highest low, basically, since the anchor date. And then the trigger price is the low. So you can see here we have a high low right there, and then we move down a couple days so it flat lines. And then we have another high low here, and we don't get a higher low until right there. So that's when it flat lines, and then it moves up. And so you can see here, because the low on this bar was below the ATR trailing stop calculated from the low, it triggered and it stopped plotting. So your stop loss would have been there at 301.48. So if you want to use intraday prices, you can calculate from the low and you can put your trigger price on the low. So that's another way to use it. Now you can also use the ATR trailing stop for short positions. So this would obviously trail when prices move down. And here I've got McDonald's, and you can see there's a support break. And so I put the ATR trailing stop. We have 22 periods. The multiplier is 2. And then on the direction, I chose short instead of long. And so what that's going to do is, you can see, and it's calculated from the close, and the trigger price is the close. So there is the close when I first calculated the ATR trailing stop, the anchor there. And so this is going to be 2 ATR 22 values above that close. And so you can see that prices fall and the ATR trailing stop falls. And then we can see we get a low close right here on this bar. And then that's the lowest close in a while. And what happens is, since prices stop falling, the ATR trailing stop flatlined. Now notice that I have the trigger price on the close. So even though we had a high above the ATR trailing stop, it didn't trigger because the trigger is based on the close. We need to get a close above that line. So prices fell again here, and so the ATR trailing stop trailed like it should. And so basically when prices are favorable, you're going to get the ATR trailing stop moving in the direction of the price. So if you're short and prices decline, the ATR trailing stop will trail down. And if you're long, the ATR trailing stop will trail up. And so it needs to close above 215.52 here to trigger that ATR trailing stop short. There is also a stop and reverse version of this ATR trailing stop. So there's parabolic SAR, which was developed by Wells Wilder. And we also have this ATR trailing stop SAR. And if you scroll down to the indicator edge, you can see it's the second one. And so what that does is, I'll put on the settings here, it's pretty much the same settings except you don't have an anchor date. It's just a continuous rolling stop and reverse. So you have a long ATR trailing stop, and if it triggers, then you have a short ATR trailing stop. So you can see here we have a long ATR trailing stop, and it is based on the close, and then we trigger, and now we have a short ATR trailing stop. And then we trigger, and we have a long ATR trailing stop, and then a short and a long. So that's the stop and reverse system there. Now, really things are a little bit more dynamic when you're taking individual positions, because one stop loss is not going to be exactly like the other one. A long stop loss might be different from a short stop loss. Volatility regimes change. Sometimes you need a tighter stop, sometimes you need a wider stop. But if you want to see how a fixed stop loss or stop and reverse would have worked over a longer period of time, this is over a year, then you can plot this ATR trailing stop SAR. And I would suggest you calculate it from the close and use the trigger price as the close to keep it uniform. Because you're using longs and shorts, you pretty much need to stick with the close, or you could use the high-low close, or high-low divided by 2, or high-low close divided by 3, possibly. But the point is, it just gives you an idea of how it would have worked over time. See, there you can see you get some whipsaws, and you caught a good trend there, caught maybe a good trend there, caught a really good uptrend there. So basically what this does is it gives you an objective systematic matter in order to set an exit once you're in a trade. So as you can see, exits are an important part of any investing or trading strategy. We need to use exits in order to first control risk, and then if prices move in a favorable direction, we need to lock in those profits because we don't want to give very many profits back. Also, we need to think about an objective and systematic approach to a stop-loss exit strategy, and the ATR trailing stop gives us that. And finally, the indicator is not perfect. No indicator is perfect. So I'd recommend you thoroughly test it, kick the tires good before you use it. Thanks very much for tuning into this presentation, and have a great day.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.